Well, it's that time again for another online macroeconomics lecture. In this particular lecture, we're going to follow up our series of lectures on money and banking and the loan creation process. We talked about the money multiplier, and we talked about how one bank can create money and how the system can create a certain amount of new loans and therefore new money. And we're really not going to focus now on what's called monetary policy. In other words, we said that the most important idea behind the loan creation process is that the amount of excess reserves at banks represent potential new monies that can be created by that particular bank. And by monetary policy, we're going to be talking about the Federal Reserve, our nation's central bank. So here we have a little picture of Federal Reserve Bank. But remember, in the United States here, we have 12 regional banks operating as our central bank. And we have the Fed chair, the vice chair, and the five other members of the Board of Governors who are assisted by the FOMC. All right, so that's going to be our focus of this particular lecture. So, 1913, the Federal Reserve was actually established, but it really wasn't until post World War II, modern macroeconomic thinking, that the Fed was aware of or instructed to its specific duties. And it's simple enough. The Fed's main goals, or our central bank's main goal, is to assist the economy in achieving full employment, non-inflationary level of output. So we're going to look at that on the next slide. We'll review this using the tools of aggregate supply and aggregate demand. But in plain English, basically, the Fed is supposed to keep the economy operating at or as close to as possible our long run average growth of about 3% GDP, with unemployment somewhere in the neighborhood of 4.5%, 5%, and inflation somewhere around 2%. Now there are central banks in other countries whose only mandate is to control inflation. In other words, to keep price levels from skyrocketing or from getting out of hand. But the Federal Reserve of the United States is actually commissioned to perform both tasks, to worry about the economic growth and therefore the unemployment rate in the economy, and to control inflation. So here is our picture using aggregate supply and aggregate demand of our long run happy-go-lucky Goldilocks economy. So as pictured here, we have aggregate demand intersecting aggregate supply, in that aggregate demand is intersecting the aggregate supply curve in that upward sloping range. So this is referred to as full employment domestic output. So it's the interaction of all buyers, in this case consumer spending, gross business investment, government spending, and net exports, right, at the general price level in the economy, right, in conjunction with all sellers, all producers of goods and services. So this is macroeconomic equilibrium at our long run average. So if the economy is in that expansionary phase of the business cycle, and it's a rather healthy expansion, so we're 2 or 3 years into an economic expansion, you would assume that GDP is growing somewhere in the neighborhood of 3%, unemployment somewhere in the neighborhood of 4.5, 5%, and price levels just about 2%. Right, so we're going to be investigating when the economy is not quite operating at or near full employment domestic output. What can the Federal Reserve do to get us back to this point? So we talk about interest rates, right? So what is the interest rate? The definition is the price paid for the use of money. So if you think about this, right, most people only think of interest rates in terms of borrowing, because we're typically familiar with borrowing. You go to buy a home and you have a mortgage interest rate. You go to buy a car and you have an interest rate on that. You go to put furniture in your house or buy some other significant item, and you might finance that item, right? And you're worried about the interest rate. People have interest rates on their credit cards. But remember, it's the rate at which money is borrowed and lent. So, it also affects lenders, right? Because higher interest rates obviously are better for lenders. Now, there are many different interest rates, and we're gonna go through the different interest rates, right? And here they are. The first rate, the discount rate, is something we spoke of in the last chapter. The discount rate is the rate at which the Federal Reserve, our nation's central bank, lends money to financial institutions, typically banks and savings and loans and thrifts, but other financial institutions, when they are short on required reserves or reserve requirements. All right, so that's the discount rate. Remember, the Federal Reserve is the lender of last resort. So if a bank can't get another bank to lend it money, right? They will come to the Fed, the lender of last resort, and borrow from the discount window, and that's the discount rate. The next important rate is the Fed funds rate. Most of the time, and during typical economic cycles, when things are not completely awry. So if we could sort of somehow disregard the 2007 through where we are standing today, 2012 debacle, for a long period of time, 97% of the time when a bank was short on a required reserve, they would borrow the money they needed overnight from another bank, and that's called the Fed funds rate. So the Federal Reserve sets that rate, or we're gonna actually talk about how the Fed actually targets the rate. It's not like they can turn a dial. I think they target the Fed funds rate, right? So again, the Fed funds rate is the rate at which one bank lends money to another bank when they're short on reserve requirements. Now you might ask yourself, why would say Bank of America lend money to Citizens Bank, right? Aren't they in competition with one another? And it actually just comes down to pure good old capitalism. If Bank of America has excess reserves at the end of the day, right, they're not going to make a loan because the business day is closed. They might as well make something off their excess reserves and lend them out to a bank who's short on reserve requirements, right? Also, it's important to understand that the Federal Reserve sets this interest rate because they don't want banks shopping around. So if Bank A is short on reserve requirements and needs to find a bank that's going to let it borrow some money overnight to meet its reserve shortfalls, they don't want Bank A calling up 17 different banks and trying to get the best rate. That's why the Fed sets its rate. If Bank A or Bank B has money to lend, they'll lend it to Bank A simply because they might as well make some money on the excess reserves overnight. Now, the most important interest rate in the economy is the last one here, the prime rate, right? Most people, or at least I would say a vast majority of people, have heard of this term before. But the definition, or the best idea associated with this prime rate is it's the rate at which banks or lending institutions lend money to their most credit-worthy customers. So if you have a very good credit score of say 700 or better, right, you're gonna get the prime rate. If you're a business and you've proven over 5, 10, 15 year period that you're a worthwhile customer and that you can be trusted with loans, right? You're gonna borrow at the prime rate. As a matter of fact, businesses who have established themselves as credit worthy will actually get rates sometimes below prime, as like here say prime minus a quarter or prime minus a half, because you know let's say Wells Fargo really wants to keep a big customer, and they'll say, yeah, we'll offer you prime minus a quarter. So if the prime rate's 3.75, and an extremely good customer might get 3.5 as an interest rate. Now these rates we're going to see is the Fed manages the Fed funds rate, and in a later slide we're going to look at the relationship between these interest rates, especially the Fed funds rate and the prime rate. All right, so when we look at the money market, which we're going to do very soon, we'll say, okay, the supply of money, the demand for money, and this is the interest rate. All right, so in generic terms, we speak as if there's only one interest rate. Just remember that when we talk about the interest rate, we're typically speaking about the interest rate that the Fed targets, the Fed funds rate, and that Fed funds rate will directly influence the prime rate. Right? So just like we studied markets for corn or wheat or electricity or coal or say labor, right? The money market has buyers and sellers, and we're going to spend some time talking about what goes into the demand for money and also how the Fed controls the supply of money. So let's start talking about the money market by looking at the demand side of the equation first. So there's two aspects to the demand for money. So why do people need money, or why do people want money? Why do people hold money? The first one's quite simple. It's the transaction demand for money. So if you can think of every time a good is produced and sold or a service is provided, money is needed to make that transaction take place, right? So normally when we talk about macroeconomic thinking, we always talk about real GDP because we want to compare actual output, taking into consideration the idea that price level changes over time. But notice here that the transaction demand for money varies directly with nominal GDP. So, in other words, as we produce more goods and services, we need more money to make those transactions take place. So if you think about the four phases of the business cycle, during an expansionary phase of a business cycle, when the economy is operating at or near full employment domestic output, there's going to be a higher transaction demand for money. Obviously, if we're in a recession, people tend to cut back on buying. The two types of purchases that we'd be chiefly concerned with is that people like you and I, consumers spending on what's called discretionary items, typically consumer durables, tends to wane a bit during a recession. In other words, people don't buy big ticket items if they're worried about their job or if they've recently been laid off, right? Likewise, there's less gross business investment, less purchases of machines and equipment and tools and things of that nature by small, medium-sized, and large businesses. So therefore, the transaction demand for money varies directly with nominal GDP. Right? Remember, nominal GDP is GDP not adjusted for changes in the price level. There's also an asset demand for money. Right? People hold money as an asset. People hold money as an asset. One of the principal ideas associated with economics is the idea of opportunity cost, something we've stressed over the course of this entire uh, macroeconomic lectures you've taken and the course you're taking right now. And again, opportunity cost is the next best alternative that you must forego or give up whenever you pursue some activity or to take part in some adventure. So it's the next best alternative that you give up. So there's an opportunity cost to holding money, and the opportunity cost of holding money is foregone interest. So if you think money held in a checking account bears very little or no interest, money held as cash bears zero interest, right? So when we talk about the asset demand for money, the asset demand for money varies inversely with the interest rate. So if you think about today's economy, right? People have $100,000 in a money market, and the interest rate is that money markets are offering now is actually less than 1%. It's something like 0.78%. So even if you had $100,000 in a money market in 1 year's time, right? 1% of 100,000 is obviously 1,000. So you're making less than 1,000. You're making about $780 minus most lending institutions or most financial institutions actually charge you a little bit to set up the account, so they're going to take some of that money away. You're not going to make up something like 600 some dollars. So the interest rate in today's world is extremely low. So there's a very little or no, hardly any opportunity cost to holding money as cash. There's very little foregone interest. But at regular periods of time, if you look at like the 70s, the 80s, parts of the 90s, money markets were paying say 8%, right? So for having $100,000 in the bank for the year, you made $8,000 for basically doing nothing except letting some other uh, institutions, peoples, or businesses borrow your money, right? So the asset demand for money varies inversely with the interest rate. And we're going to look at these two aspects, the transaction demand for money and the asset demand for money. We're going to look at them separately on a graph, and then we're going to talk about the total demand for money made up by these two. So even though we introduced them separately, the total demand for money is made up of both the transaction demand for money and the asset demand for money. So on your far left here, it says transaction demand, right? You can see that the transaction demand for money graphs as a vertical demand curve. So think about what we just stated as the transaction demand for money varies directly with nominal GDP. So if we produce more goods and services, that curve would shift to the right, right? There'd be a higher transaction demand for money. And if the economy slows, that particular curve would shift to the left, right? The asset demand for money, it looks like our typical demand curve. It's downward sloping. If you remember the definition of demand way back from chapter 3, that there's an inverse relationship between price and quantity demanded. Well, here, be careful because on these particular graphs, the vertical axis is not price anymore. We could call it the price of money, right? Because that's when we talked about the interest rate. We defined that earlier. But the vertical axis is the interest rate, and the horizontal axis is still quantity, right? But here, at a very high interest rate of say 7.5%, there's a very low asset demand for money. Right? So the higher the interest rate, the lower the asset demand for money, that inverse relationship between the asset demand for money and the interest rate in the economy. Right? On the far right, we had simply brought these two aspects of the demand for money together, and from here on in, we're just going to be using that demand curve, right? The total demand for money. Just remember that the total demand for money is made up of both the transaction demand for money and the asset demand for money. Now, there's one caveat here, and this is kind of important, right? This term velocity, right? So maybe some of you have played that game like Where's George, where people actually write their name on a dollar bill. They write where a dollar bill's been. And you can track online with the the serial number of the dollar, and you can find out where that dollar's traveled throughout the year or something. It's a similar idea, but the velocity it's easy to define. It's simply the number of times over in a year in which a dollar is spent. So how many times that same dollar is spent in a year. So the speed at which money circulates, that's the velocity of money, right? So if you remember when we first introduced the idea of gross domestic product, so gross domestic product is the best way to measure economic activity, right? It's the monetary measure of all final goods and services produced within the domestic borders of the United States in a given year, right? This is old hat for people who've been studying macroeconomics for quite some time. So GDP equals P times Q. In other words, the price of all goods and services, final goods and services, times the quantity of those goods and services bought and sold. But we could also say that GDP equals M, which is the supply of money, times V, the number of times those dollars are spent over in a year. Right? This is called the equation of exchange. Right? GDP equals M times V, the supply of money times the velocity of money. Right? So when you think about the transaction demand for money, right, during a recession, the velocity is going to slow down quite a bit. And during an economic expansion, velocity would speed up somewhat. So here is our demand for money. Let's bring in the supply of money, right? All the way on the right now. Now we have the total money market, right? Now we have the total money market. And notice first that the supply of money is a vertical curve. It graphs perfectly straight up and down. If you've taken microeconomics, we would say that that would be a perfectly inelastic supply curve, right? For those people who have taken microeconomics, right? Why is the supply of money perfectly vertical? Well, in theory, we could go out and count up all of M1 and M2, right? Remember our definitions of money? M1 being coins, currency, and checkable deposits, and M2 being a whole group of near monies, money market demand accounts and savings accounts and money market mutual funds. So, it would be a difficult task, but the Federal Reserve actually has a pretty rough idea of how much money is in circulation today. So the supply of money at any point in time is fixed. That's why it is a vertical curve, right? So if you see, what happens is when we bring together the supply of money with the demand for money, we have the interest rate. So as drawn on the far right here, at this point in time, given this supply of money and this demand for money, the interest rate in the economy, or the real rate of interest, would be 5%. So what happens then if the supply of money changes, right? So if we start off at that 5% interest rate, what would happen if the supply of money decreased? Well, obviously, this would drive up the interest rate, right? Well, now you understand monetary policy. We'll go over in detail how the Federal Reserve alters the supply of money in the economy, but the lesson is straightforward here. If the Federal Reserve desires higher interest rates, they will shrink the money supply. They will take some money out of circulation, right, which would drive up interest rates. Now remember, higher interest rates would stifle economic activity, would slow down total spending. So this would be appropriate monetary policy if the economy is experiencing demand pull inflation. So if we're at or beyond the expansionary phase of the business cycle and demand pull inflation was the particular problem, then the Fed would desire higher interest rates, which would make it more costly to borrow and spend for both businesses looking for new projects and for people like you and I buying cars and homes and such, right? Likewise, if the Fed wanted to stimulate economic activity, they would want lower interest rates. So by increasing the money supply, the Fed actually brings down interest rates, and that's what the Fed's been doing in large quantities since the financial crisis began back in late 2006, early 2007. The remainder of these lectures is simply going to focus on how the Fed manages the nation's money supply.